Hello everyone, and welcome back to our channel. Today, we're diving deep into one of the most fascinating topics in the world of investing, Warren Buffett's strategy, specifically his approach to patience versus short-term gains. Warren Buffett, often called the Oracle of Omaha, has been a symbol of smart investing for decades. But what truly sets him apart is not just his immense wealth, or his ability to pick winning companies, it's his philosophy of long-term thinking. Now, you might be wondering, why is patience so important in investing? Why does Buffett advise us to avoid chasing quick profits? Let's break it down. Buffett's approach is built on a few core principles. 1. Invest in quality, not quantity. Buffett doesn't buy stocks because they're trending or because everyone else is buying them. He looks for businesses that are strong, reliable, and sustainable. These are companies with good management, solid financials, and a proven track record of performance. 2. Think long-term. Buffett once famously said, "Our favorite holding period is forever." This doesn't mean never selling, but it reflects a mindset where you invest in companies because you believe in their long-term growth potential, not because you want a quick payday. 3. Ignore short-term noise. Stock prices move up and down every day, often without any connection to the real value of the business. Buffett doesn't let daily market fluctuations affect his decisions. Instead, he focuses on the fundamentals of the company. Let's take an example. Imagine you invest in a strong company that consistently earns profits, pays dividends, and has a loyal customer base. In the short term, its stock might go up or down due to market rumors, economic news, or even investor panic. But if you believe in the company's long-term potential, these short-term changes don't matter. This is where patience comes in. Buffett understands that compounding, the process where your investments grow exponentially over time, requires time, sometimes decades. Quick gains might seem tempting, but they rarely offer the same growth potential as a steady, long-term investment. Another key aspect of Buffett's strategy is emotional discipline. Most investors react emotionally to market volatility, they panic during dips, or they get greedy during highs. Buffett, on the other hand, remains calm and rational. He uses these market fluctuations as opportunities, not threats. In essence, Buffett's strategy can be summarized in one sentence: buy strong businesses, hold them patiently, and don't get distracted by short-term market noise. In the next segment, we'll dive deeper into the dangers of chasing short-term gains and why so many investors fail by ignoring this crucial principle. We'll also explore some real-world examples where patience really paid off for Buffett and his investors. So stay tuned, because understanding this balance between patience and immediate profit can completely change the way you think about investing. Now that we've explored Warren Buffett's emphasis on patience, let's take a closer look at the temptation of short-term gains and why so many investors fall into this trap. Short-term gains are all around us. Headlines scream about stocks that doubled in a week, cryptocurrencies that skyrocketed overnight, or the latest, hot stock, everyone is talking about. It's incredibly tempting to jump in and try to grab these quick profits. After all, who wouldn't want to make money fast? But here's the catch. Short-term thinking is risky, emotional, and often leads to mistakes. 1. The illusion of quick profits. When a stock jumps 20% in a few days, many investors believe they've discovered a hidden treasure. But in reality, these quick gains are often driven by hype, speculation, or market sentiment, rather than the actual value of the company. For example, during a market bubble, everyone rushes to buy a trending stock without checking whether the company is truly profitable or sustainable. Prices rise, but eventually, reality catches up. And when the bubble bursts, investors who chased short-term gains often lose more than they made. Buffett has warned about this for decades. He calls this market noise, the constant fluctuations in stock prices that have nothing to do with the underlying business. Reacting emotionally to this noise is what separates successful long-term investors from the rest. 2. Emotional investing. The human brain is wired for instant gratification. Seeing a stock rise quickly gives a rush of excitement, while a sudden drop triggers fear and panic. Most short-term traders act on these emotions, buying high out of greed and selling low out of fear. Buffett's approach is the opposite. He trains himself to be emotionally detached from the market. For him, a price drop is not a reason to panic, it can be an opportunity to buy more of a great business at a discount. Conversely, a sudden price surge is not a reason to celebrate, it's a reminder to stay focused on fundamentals, not hype. 3. Short-term versus long-term risk. Many investors think short-term gains are safer because they can get in and out quickly. But in reality, short-term trading is far riskier. Why? Because the market is unpredictable in the short run. News, rumors, economic data, or even social media trends can swing prices dramatically in hours or days. Buffett looks at risk differently. For him, risk comes from not knowing what you own or from overpaying, not from temporary price movements. A strong company might fall 20% in a week, but if its business model is sound, it can recover and grow over years. Short-term investors see the drop and panic, while long-term investors see opportunity. 4. Real-life examples from Buffett. Let's look at some examples from Buffett's career. Coca-Cola. Buffett began buying Coca-Cola shares in 1988. At that time, the stock had its ups and downs, like any other company. Many investors were focused on short-term fluctuations, but Buffett saw a strong brand, loyal customers, and consistent earnings. Over the next 30-plus years, those shares grew exponentially, rewarding patient investors far more than any short-term trading could have. American Express. During the 1960s, salad oil scandal, American Express faced massive losses and its stock plummeted. Short-term investors panicked and sold. Buffett, however, recognized the company's long-term potential and invested heavily when prices were low. Decades later, this became one of his most profitable holdings. These examples show a key principle: short-term setbacks do not equal long-term failure. But chasing short-term gains often leads to missed opportunities and unnecessary losses. 5. The opportunity cost of quick profits. Another important point Buffett emphasizes is opportunity cost. When you focus on small, immediate profits, you might be distracted from larger, long-term opportunities. Imagine you spend all your time chasing small, unpredictable gains. You might miss out on investments that could double or triple over a decade. Buffett's strategy is to align money with time, not timing. He invests in companies that can grow steadily over years, allowing compounding to work its magic. Short-term trading rarely allows this kind of exponential growth. 6. Psychological pitfalls. Short-term thinking also leads to stress, anxiety, and bad decision-making. Watching the market every minute, obsessing over price changes, and constantly comparing yourself to others can cloud judgment. Buffett, in contrast, lives by the philosophy: be fearful when others are greedy, and greedy when others are fearful. This requires patience, discipline, and a long-term perspective, qualities that short-term traders often lack. In summary, the lure of short-term gains is powerful, but it's filled with risk, emotion, and distraction. Warren Buffett's strategy teaches us that true wealth comes from patience, not speed. When it comes to investing, patience alone isn't enough. The next critical step is choosing the right companies to invest in, because long-term holding only works if the businesses themselves are strong and sustainable. Warren Buffett emphasizes investing in companies that are exceptional, reliable, and have the ability to grow over decades. He often says, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." So, what defines a wonderful company? 1. Durable competitive advantage moat. Buffett looks for businesses with a durable competitive advantage, or a moat, that protects them from competitors. This could be a strong brand, a unique product, or exclusive services that others cannot easily replicate. Coca-Cola, for example, is recognized worldwide. Its loyal customers ensure consistent sales year after year. Even if competitors try to enter the market, Coca-Cola's position remains strong. Other examples include companies like Apple, American Express, and Geico, all of which have moats that allow them to survive economic challenges and maintain steady profits. 2. Strong management. Buffett also invests in companies with competent, honest, and shareholder-oriented management. He trusts leaders who reinvest profits wisely, prioritize long-term growth, and make decisions transparently. This is why Buffett allows Berkshire Hathaway's subsidiaries to operate independently. He trusts strong management to run the business without interference, demonstrating that trustworthy leadership is essential for long-term success. 3. Consistent earnings and cash flow. Predictable earnings are another hallmark of Buffett's investments. He prefers businesses that generate steady cash flow, which allows him to calculate the company's intrinsic value accurately. A company with volatile earnings may look attractive in the short term, but it poses long-term risks. Buffett avoids speculation and instead focuses on financial stability and reliability. 4. Reasonable valuation. Even the strongest company can be a bad investment if bought at too high a price. Buffett uses value investing principles, analyzing a company's financial health, intrinsic value, and long-term prospects. He waits patiently for the right opportunity instead of overpaying for temporary hype. During the late 1990s dot-com bubble, for instance, Buffett avoided most tech stocks because prices were excessively high. Many investors chasing short-term gains suffered massive losses when the bubble burst. Buffett's patience and discipline shielded him from those losses. 5. Real-world portfolio examples. Companies like Coca-Cola, Apple, and BNSF Railway reflect Buffett's investment principles. They all share strong competitive advantages, reliable management, consistent earnings, fair valuations. Investing in such companies allows Buffett to hold for decades, leveraging compounding and minimizing risk. 6. The power of compounding. Compounding is the engine behind Buffett's wealth. By holding high-quality investments for decades, even modest returns multiply exponentially. Short-term traders miss this magic because frequent buying and selling prevents sustained growth. Patience, combined with careful company selection, transforms investing from a gamble into a strategic, long-term wealth-building activity. Patience and careful selection of companies are only part of Buffett's formula. The final element is observing the results of this strategy over time and understanding why it consistently outperforms short-term speculation. 1. The impact of staying the course. One of the defining features of Buffett's career is his ability to stay calm during market turmoil. While most investors panic when prices drop, Buffett evaluates the fundamentals of the company. During major market downturns, such as the 2008 financial crisis, stock prices plummeted. Many investors sold their holdings in fear, locking in massive losses. Buffett, however, saw this as an opportunity to invest in strong companies at discounted prices, including Goldman Sachs and General Electric. Over time, these investments generated significant returns. This demonstrates a critical principle: patience isn't passive, it's strategic. It's about making informed decisions without being driven by emotion. 2. The cost of chasing short-term gains. Short-term thinking often appears tempting because it promises quick profits. Headlines, social media trends, and sudden spikes in stock prices lure investors into rapid trades. However, chasing these gains carries significant risks. Market volatility. Short-term price swings are often unpredictable and unrelated to company fundamentals. Emotional trading. Investors frequently buy high out of excitement and sell low out of fear. Missed long-term growth. Focusing on quick profits distracts from opportunities that could multiply wealth over decades. A comparison highlights this clearly. An investor who trades frequently may make some profits, but frequent mistakes, fees, and market timing errors often negate these gains. A patient investor, following Buffett's principles, invests in strong companies and allows compounding to work. Over time, even modest returns multiply exponentially, creating far greater wealth than short-term trading could ever achieve. 3. Real-life examples of long-term success. Buffett's portfolio offers concrete proof of his strategy. Coca-Cola, bought in 1988. Despite market fluctuations, dividends and long-term appreciation turned an initial investment into billions over decades. Apple, purchased starting in 2016. Though initially cautious, Buffett recognized the company's strong brand and consistent growth. In just a few years, these investments generated enormous returns. BNSF Railway, acquired during the 2009 financial downturn. While many investors were scared, Buffett recognized the long-term potential. The company steadily grew, proving the value of investing in strong businesses during market lows. Contrast this with investors chasing trends or hype. Many bought at peaks and sold at lows, losing capital and missing out on dividends and long-term gains. Buffett's patience consistently outperformed short-term speculation. 4. Psychological lessons for investors. Buffett's success is not just financial, it's psychological. Some key takeaways: ignore the crowd. Herd mentality often leads to buying high and selling low. Focus on intrinsic value. Daily market movements are often irrelevant to a company's true worth. Be disciplined. Patience is a superpower in a world obsessed with instant gratification. Use fear as opportunity. Market downturns are chances to invest in great companies at lower prices. By mastering these psychological principles, Buffett transformed investing into a calculated, long-term strategy instead of a gamble driven by emotion. 5. Compounding and time, the true game changers. Compounding is the cornerstone of Buffett's wealth-building approach. Even modest returns, when held for decades, multiply dramatically. This is why long-term holding beats trying to time the market. Short-term investors miss this magic because frequent trading interrupts compounding and introduces unnecessary risk. Buffett's approach proves that time is your greatest ally, and patience is more valuable than quick profits. 6. Lessons any investor can apply. While not everyone can be Warren Buffett, his principles are applicable to any investor. Invest in companies with strong fundamentals and competitive advantages. Avoid chasing trends or hype for quick gains. Think long-term and focus on compounding. Remain disciplined and avoid emotional decisions. Use market downturns as opportunities, not threats. These lessons show that wealth is built slowly, strategically, and patiently, rather than through impulsive decisions or chasing short-term excitement. 7. Closing thoughts. In today's fast-paced world, where instant results are glorified, Buffett's strategy might seem counterintuitive. Yet history proves it works. The stock market transfers wealth from the impatient to the patient, and those who embrace long-term thinking consistently come out ahead. Warren Buffett didn't achieve his wealth by following trends or chasing headlines. He achieved it by thinking differently, investing in strong businesses, and patiently letting time work its magic. For anyone serious about investing, the lesson is clear. Don't rush, don't panic, invest wisely, hold patiently, and let compounding do the rest. By following this approach, you can create sustainable wealth that grows steadily over time, exactly as Buffett has demonstrated for decades.